Welcome to Lucidity Insights podcast, where we talk about the ins and outs of the emerging market tech ecosystems here in the Middle East and Africa. And I'm your host, Erica Welch. I also happen to be the Chief Content Officer at Lucidity Insights. You may be asking yourself, what is Lucidity Insights? Well, we're a data and insight streaming platform specialized in investigative deep dive reports on the Middle East and Africa's startup ecosystems. We tell data-driven stories in the format you want, whether it's reports and articles, infographics, videos, or podcasts like this one. Check out more at lucidityinsights.com. Welcome to our third and final episode in this enlightening three-part series where we conclude our exploration of the dynamic African startup ecosystem. We'll connect the dots and showcase the sectors, trends, and regions where the future holds the most promise. So without further ado, let's dive into where opportunities can be found in Africa's startup ecosystem, the grand finale of the Future of Fintech in Africa series. Now, let me speak a little bit to actually investing in startups in Africa. Where do you start and what do you need to know? First, I want to say there are opportunities everywhere. But we took a look at the data, and it also told us that the majority of startup investment opportunities are concentrated in a few markets. Let me start by talking about wealth in Africa. Who's creating it and where is it coming from? So if you look at the GDP of all 54 countries across Africa, you'll notice something really interesting. And that's that the top three countries, which is Nigeria, South Africa, and Egypt, contribute to 46% of the entire continent's GDP. And if you expand that to 11 markets, they contribute 70% to the country's total economy. So it might not come as a surprise to you that when we look at the startup data, the ecosystems that are developing the most funded startups are also coming from these three countries. That's Nigeria, Egypt, and South Africa. We evaluated all the startup funding coming from Africa and found that there are over 800 scale-ups across the continent. So what are scale-ups? Scale-ups are startups that have successfully raised $1 million or more. 60% of these scale-ups came from Nigeria, South Africa, and Egypt. And 1 in 3 scale-ups in Africa are actually fintechs. And out of the 270 plus fintechs on the African continent right now, fintech scale-ups, 64% are coming from these three countries. Now, it's important that when I kept mentioning these three markets to many of the VCs and investors I've spoken to on the continent, they call it the 3+1. It's not just Nigeria, South Africa, and Egypt, but it's also the +1 being Kenya. In 2022, Kenya attracted just 7% less funding than South Africa, as you can see in this info bite. And if there was a +2, the fifth market of interest would be Ghana. But in 2022, Ghanaian startups attracted 3.5x less funding than Kenya, indicating a wider gap and perhaps less opportunities for investment in Ghana. And I've just pulled up some more recent data that's come out in the last week. If you look at this year's funding data to Q3 2023, it's a balanced spread. 300 million going to Nigeria, 300 million going to South Africa, 300 million going to Egypt, and 200 million going to Kenya, while the rest of Africa have had 300 million invested in it so far this year. But let's also not gloss over the challenges that Africa faces. Africa faces unusual barriers to startup ecosystem growth. And the first, which might sound strange, is actually language. There are over 2,000 languages spoken on the African continent. And this is why a lot of investors love markets like Egypt, where there's 1 or 2 languages that can really drive a startup or product forward. But you take a market like Nigeria, and there are 500 languages spoken. That's a lot more investment for customer acquisition than in other markets. Now, After you get your head wrapped around the fact that in some markets, your product will have to be launched in multiple languages, then you have to consider the literacy rate across Africa. There are only 3 countries in Africa that have literacy rates above the world average of 87%. That's Morocco, South Africa, and Côte d'Ivoire. For example, only 73% of Egyptians aged 15 years and older are literate. That means startups have to employ multilingual sales teams that acquire customers in person, and the cost of customer acquisition is high. Then there's the issue of internet and smartphone penetration lags. Mobile penetration rates, though growing, still sits at 46%. So only half of Africans have access to a mobile phone. And that's not smartphones we're talking about, that's just general feature mobile phones. For example, only 15 out of 54 countries in Africa have above world average smartphone penetration rates, which stand at 67%. And more importantly, though, are the internet penetration rates. There's something we call the smartphone internet gap in Africa, where some individuals in Africa choose to purchase a smartphone, but they actually don't have the means to get internet connectivity. And that might be due to lack of affordable and reliable internet connections across the continent. When we looked at venture funding data, we saw that 1% to 2% of global VC funds are going into Africa. And when we look at fintech funding data, it's a little bit stronger. We're looking at 4% to 5%. And as we dissected the data further, what we find in Africa is generally lower ticket sizes and earlier stage investments. But VC funding in Africa has tripled in the last 3 years. In 2020, African startups had yet to break the $1 billion in VC funding mark. And in 2021, that shot up to $4.1 billion. And last year, African startups fundraised $3.8 billion. The VC winter has started to creep into Africa, though, particularly in the last quarter, with African startups only raising $1.5 billion year-to-date to Q3 2023. Lastly, I'm going to leave a quote from Karim Aziz, the global head of digital payments investments at the IFC. I spoke to him about the headwinds African and emerging market startups are facing today, and this is what he had to say. Unfortunately, every time the Fed raises interest rates, it strengthens the US dollar and weakens many emerging market currencies. What that means is that there may be vulnerabilities in markets like Nigeria, Turkey, Egypt, and Pakistan. As VCs tend to raise capital in US dollars, there will be pressures on VCs to hedge foreign currency risk by going and investing in markets where foreign currency is more stable or have no choice but to lower valuations. That said, there is a lot of dry powder out there. I expect that it will be used predominantly to fund current market leaders to help them consolidate their market leadership position through acquisition in the coming year or two. And that's exactly what we are seeing. If you look at this info bite here, before last year, 85 to 95% of exits were predominantly done through acquisition. And in the last year and a half, we've seen 25% of exits on the African continent done through exits. Okay, that's it. Thank you for joining us on our special report mini-series covering the future of fintech in Africa. There's so much more we could talk about with regards to the goldmine of data and insights that's in this report, but there's only so much time. So if you like what you heard, then go to lucidityinsights.com and read the full report. It's free. And check out our other content, whether it's articles, startup case studies, investor profiles, or video content and podcasts like this one. lucidityinsights.com, always here to help.